An annuity is a type of investment account that can provide supplemental income upon retirement. Like other types of investment accounts, annuities have their benefits and drawbacks. Let's learn more about how annuities work, their main pros and cons, which types to consider, and who can benefit the most from an annuity. Hi, this is Ivory Hecker for Noble Gold News. As you know, we are committed to providing you with objective and relevant information to help you prepare for retirement. For today, let's look at annuities. Annuities are contracts between an investor and an insurance company. You can start one with a lump sum of cash and continue to make contributions as desired. The returns on your investment can be fixed or variable depending on the type of annuity you choose. Here's a quick overview of three main types. Fixed annuities, these offer a guaranteed return, making budgeting easier during retirement. However, they might limit potential higher returns. Variable annuities. Your money is invested in stocks and bonds, potentially yielding higher returns over time. However, your investment is subject to market risks and might perform below expectations. Indexed annuities. Your funds are tied up in a stock market index like the S&P 500 or the Dow Jones. This approach is generally less risky than direct investments in stocks and bonds, but riskier than fixed annuities. So, is an annuity a good choice if you're nearing retirement? Annuities offer several benefits. They can provide a stable and predictable income during retirement, making them especially useful for individuals seeking comfort and financial security. They are also an excellent option for high-income earners who have already maxed out their contributions to other retirement accounts. It offers guaranteed income. Annuities can provide a steady income when you retire, supplementing other sources like Social Security and 401k or an IRA. Having this guaranteed income from an annuity can enhance your financial stability in retirement, allowing you to enjoy those years without financial worries. Fixed returns. Fixed annuities provide a consistent return, helping you know exactly how much money you'll have in retirement. This predictability makes budgeting easier and retirement more comfortable. No contribution limits. Unlike 401ks and IRAs, which have annual contribution limits set by the IRS, annuities don't have a cap on how much you can contribute. This is particularly beneficial for high-income individuals who wish to save more for retirement than what other plans allow. Annuities give you the flexibility to save as much as you want, though they typically require a minimum amount to get started. Potential disadvantages of annuities. However, annuities do have their downsides. They often come with annual fees, and withdrawing money before retirement can lead to significant penalties. The funds in an annuity are also locked in during the contract period, which can be problematic if you're facing an unexpected financial need. Moreover, depending on the annuity type, you might end up paying more to the insurance company than you or your heirs get back. Fees and penalties. Annuities typically have annual fees of around 2% to 3% to cover the costs of investment management and other services. Additionally, similar to other retirement plans like 401ks, there's a 10% penalty tax for withdrawals made before age 59 and a half. This penalty is enforced by the IRS, and annuities generally offer fewer exceptions for early withdrawal than 401k plans do. Inaccessible funds. Once you've invested in an annuity, those funds aren't accessible until you reach age 59 and a half. For many investors, this isn't an issue, but if you encounter a large unexpected expense, accessing your money early will incur a 10% penalty, which is why having an emergency savings fund and other more liquid investment options is crucial, allowing you access to funds when needed. Potentially variable returns. Well, a fixed annuity offers a guaranteed rate of return. Variable and indexed annuities can see fluctuating returns. This variability is because these annuities invest in stocks, bonds, or mutual funds, which are subject to market ups and downs. If the market declines, your annuity value may also decrease. Conversely, if the market does well, a variable or indexed annuity could earn a higher return. Unlike a fixed annuity, which remains constant regardless of market conditions. Possibility of no inheritance for heirs. With certain types of annuities, there's a risk involved. If you live longer, you could receive more than what you paid. If you pass away early, you might end up receiving less than what you invested, leaving little or nothing for your heirs. However, as noted by Northwestern Mutual, annuities can be structured in several ways to potentially leave money for your beneficiaries. The choice of annuity structure will influence the size of your monthly payments and the benefits your heirs may receive. Life-only annuity. Payments stop when you die, or if it's a joint life annuity, when the second person dies. Any remaining funds stay with the insurance company. Life with refund. You receive payments for life. If you die before fully recouping your initial payment, your beneficiary receives the remaining balance. Life with period certain. You receive lifetime payments and you choose a specific period like 10 or 20 years for guaranteed payment. If you die within this period, your beneficiary continues to receive payments until the end of that period. Period certain only. Payments continue for a preset period. If you pass away before this period ends, your beneficiary receives the remaining payments. If you outlive the period, payments cease. Who will benefit the most from annuities? Well, annuities offer many benefits. They aren't suitable for everyone. Here are some scenarios where an annuity might be particularly beneficial. For high earners, if you have a high salary and you've already maxed out your contributions to other retirement accounts, an annuity offers an additional avenue to save more for retirement. For retirees, if you've already retired and looking for ways to supplement your income, an annuity could be a viable option. Choosing an immediate annuity means that you start receiving payments right away, helping to cover daily expenses in place of a regular paycheck. It's important to remember that annuities can be volatile and tie up your funds. While they can supplement retirement income, annuities shouldn't be your only financial resource. Consider the pros and cons and perhaps consult a financial advisor to determine if an annuity is right for you. Why might annuities be considered a poor investment choice? Annuities can be less appealing due to higher fees and less flexibility compared to other savings options. Depending on the type you choose, there's also a risk that your heirs may receive nothing upon your death, even if the payouts were less than your total contributions. However, for those who've maxed out their 401k or IRA contributions, annuities can still be a strong option to further save for retirement. Is there a better option? Well, for many, especially those with high incomes, annuities are a solid choice. Yet for others, employee-sponsored plans like a 401k often offer the best route for retirement savings. You can also consider opening an individual retirement account, IRA, to boost your savings for the future. If your income allows you to max out your contributions to these plans, then adding an annuity can be an effective way to continue growing your retirement savings.